Hey, what's up guys? It's Johnny, and today I'm going to be talking about what a good IRR looks like. So if you're analyzing a real estate deal and you want to make sure you get your numbers right, stick around for this video. So check this out. If you're new here on this channel, we talk about wholesaling, real estate investing, and financial modeling. So if you're somebody who wants to get started in real estate investing, don't forget to like and subscribe. When analyzing a new real estate acquisition, one of the most important metrics you're going to need to know is going to be your internal rate of return, or your IRR. And when considering what a good IRR is, there are two terms you need to know. Typical unlevered IRR is probably going to be between 8 and 12% plus, while levered IRR is likely to be 12% to 22% plus. Okay, so there's going to be a couple things that impact the IRR on any given deal. And the very first is going to be the risk profile. Generally speaking, the higher the risk, the higher the IRR tends to be. The opposite is true with a deal that is less risky. Usually the IRR is going to be a little bit lower. And the reason for this is because investors are always going to evaluate the risk reward profile on any given deal. So if an investor is going to take on risk where it's like a ground up development or something that needs like major rehab, they're going to want to be compensated by taking on that risk with a higher IRR. The same is true when you have maybe a safer play in like a core or more stabilized market with a stabilized asset. The investors are going to be okay with a lower IRR because it's a less risky deal. So the second big factor is going to be timing. And what we're talking about is the time value of money. Now, the easiest way to understand kind of this concept is by looking at two different scenarios side by side. So I'm going to give you two scenarios, okay? And in both scenarios, you are going to invest $100,000 into a deal. And in both scenarios, you are going to make $50,000 on the deal, meaning you give $100,000 and you get $150 back. Okay, so scenario A, you invest $100,000 in a deal that has a 3-year hold period with no cash flow. So you give $100,000 today, and at the end of month 36, you get a check back for $150,000. So you've netted $50,000 on this deal. So let's compare that to scenario B, where maybe you write a check for $100,000, and after 12 months, you get your initial $100,000 back, and then after 24 months, you get another $25,000, and after 36 months, you get another $25,000. So in both scenarios, you've made $50,000, but in scenario B, you got all of your money back after only 12 months. So when you look at these two scenarios, it's pretty clear that scenario B is probably the better of the two investments, right? Because you're getting your money back faster, and then you can take that money and invest it in other deals. There's a value to that. There's time value to having your capital back so you can redeploy it. And IRR takes that into account. So at the end of the day, when you're doing an analysis and you want to know, is this a good deal for me and is a good IRR, the two things that you want to consider are going to be the risk profile and how long you plan on holding the property. I hope this was helpful as you go into your next deal analysis. And if you want to learn more on how you can passively invest in real estate, I have a free passive investor's guide. Link is in the description below. Thanks for stopping by. God bless.